Okay everyone, in this video presentation I'm going to be covering 5 different topics all related to risk management. The first one that I'm going to be covering is what is risk management. I think it's very important for everyone to understand what risk management is and how it can actually affect your trading. Then I'm going to be moving on to trading capital. Now what I mean by trading capital is how much do you actually need in order to start trading Forex, in my opinion. Then I'm going to be moving on to drawdowns. We're going to be covering a bit about drawdowns, what drawdown is and how to deal with drawdowns. The next one is the magic number. Now what I mean by magic number is how much percentage wise should you risk on any given trade. Okay, so out of your entire account balance, how much percentage wise you should risk on each trade. And last but not least, I'm going to be covering the importance of risk reward to risk ratio. Okay, let's move on to what is risk management. Risk management is the most important topic you will ever read about Forex trading or any type of trading. Now, why, you might ask, is it important? Well, the simple answer is we are in the business of making money. And in order for us to make money, we need to learn how to manage our risk, aka potential losses. Now, ironically, this is one of the most overlooked areas in trading. Many Forex traders are just so anxious to get into trading with no regard for their total account size. They simply determine how much they can stomach to lose in one single trade and they hit that trade button. Now in my eyes, this type of trading is called gambling, and it's as simple as that. When you trade without risk management rules, what I need you to understand is you are in fact gambling. You are not looking at the long-term return. Instead, you are looking for that jackpot. Understand this, and I hope this drills into your head. Risk management rules will not only protect you, but they can make you very, very profitable in the long run. If you don't believe me and you think that gambling is the right way to get rich, then consider the following example. People go to casinos to gamble their money in hopes of winning what? The jackpot. And in fact, people do win. So my question is, how in the world are casinos still making money if many individuals are winning that jackpot? The answer is that while even people win jackpots, in the long run, casinos are still profitable because they rake so much more money from the people that don't win. You have heard the phrase, the house always wins, and that's where it comes from. The truth is that casinos are just so smart. They know that in the long run, they will be the ones making the money and not the gamblers. Okay, now let's say Mr. X wins £100,000 jackpot in a slot machine, for argument's sake. The casinos know that there will be hundreds of other gamblers who won't win. And that money will go right back into their pockets. This is a classic example of how statisticians make money over gamblers. Even though both lose money, the casino in this case knows how to control its losses. And that is what you need to learn, is how to control your losses. Essentially, this is how risk management works. If you learn how to control your losses, let me tell you one thing. You will have the chance at being profitable. It's as simple as that. Now, in the end, Forex trading is a numbers game, meaning you have to tilt every little factor in your favor as much as you can. You guys, listen, you want to be the casinos. and not the gamblers. Because in the long run, you want to always be the winner. I hope that makes sense. Now I'm going to be moving on to trading capital. There's a great saying out there. It takes money to make money. You need trading capital. Everybody knows that. But how much does one need to get started in Forex trading? The answer largely depends on how you're going to approach your new startup business. But firstly, I want you to consider, how are you going to be educated? Now, there are many different approaches to learning how to trade. It could be through classes, mentors, or even on your own. Or just combine any of the three. While there are many classes and mentors out there that are willing to teach Forex, most will charge a hefty fee. But the benefit of this route is that a well-taught class or a great mentor, now let me highlight in bold, great, can significantly shorten your learning curve and get you on your way to profitability in a much shorter time than trying to doing it all on your own. Now, be careful here looking for mentors. There's so many mentors out there. To be honest with you, they're marketeers. They're just trying to sell you programs. Okay, they probably don't even trade for themselves. So go out there and take your time and look for amazing mentors. There's a downside to this, that it's basically the upfront cost. Some of these programs can range from hundreds, if not thousands of pounds, depending on which program you go with. For many of these new traders, the resources required to purchase this program are just not available. Okay, it's too much. But for those of you who are unwilling to pony up the cash for education, there's a good news here. Most of the information you need to get started in Forex is completely free and can be found on the internet through forums, brokers, articles, and hundreds of websites out there. But again, please be careful which website you go to. So, how much trading capital do you need? Let's be honest here. If you're consistent and you practice proper risk management techniques, then you can probably start off with £10,000 in your trading capital. It's common knowledge, okay, that most businesses fail due to undercapitalization. But it's especially true in Forex trading. So don't go out there thinking that you're going to fund your account with £200, turn that £200 to 100,000 in a few months. Forget that idea. If you are unable to start with a large amount of trading capital, then you be patient. Save up and learn to trade the right way until you are financially ready. Let's move on to drawdowns. So I hope you know that risk management will make you money in the long run. But now I'd like to show you the other side of things. What would actually happen if you didn't use risk management? Now I want you to consider the following example. Let's just say you have a £100,000 account and you lose £50,000. What percentage of your account have you just lost? The answer is simple, 50%. This is what traders call a drawdown. A drawdown is the reduction of one's capital after a series of losing trades. This is normally calculated by getting the difference between the relative peak in capital minus the relative throws. Now, majority of the traders normally note this down as a percentage of the trading account. In trading, we are always looking for that edge. I mean, that is the main reason why traders develop systems. Now, a trading system that is 70% profitable sounds brilliant, don't it? It's a very good edge to have. But just because a trading system is 70% profitable, does that really mean for every 100 trades you make, you will win 7 out of 10? Not really. Because how do you know which 70 out of these 100 trades will be winners? The answer is you don't. You could lose the first 30 trades in a row and win the remaining 70, correct? Now that would still give you a 70% profitable system. But you have to ask yourself, would you still be in the game if you had lost 30 trades in a row? Probably not. This is why risk management is so important. No matter what system you are trading, you will eventually have a losing streak. I mean, even professional traders who make their living through trading go through horrible losses. Okay, they go through horrible losing streaks like everybody else, and yet they still end up profitable. Why do you think that is? The reason is because even good traders practice risk management, because they know that they will not win every single trade. So what do? They only risk a small percentage of the total account. And why do they do that? Is because they want to survive those losing streaks. Now, that is what you must do as a trader. What you also have to understand is drawdowns are part of trading. Now, the key to being successful in Forex trading is coming up with a trading plan that enables you to withstand these periods of large losses. And part of this trading plan is having a risk management rule in place. You need a risk management rule in place. So only risk a small percentage of your trading account so that you can survive a losing streak. Remember that if you practice strict money management rules, you will become the casinos, and in the long run, you will always win. Now let's move on to the magic number. How much should you risk per trade? Now that is a great question. In my opinion, I think you should try to limit your risk to 2% per trade out of your entire account balance. 2% per trade. But that even might be a little too high for newbie traders. Now I'm going to illustrate and show you the difference between risking a small percentage of your capital per trade compared to risking a higher percentage. Now we're going to take risking 2% versus the 10% per trade. And this whole illustration that I'm going to give you or talk you through will be based on this. The difference between the 2% and the 10%. Now, imagine you're starting with £20,000 in your account balance, but you go through a losing streak of 19 trades. So you've just lost 19 trades in a row. If you had risked 10% per trade, you will end up with £3,002. Now, can you see? You have just lost over 85% of your entire account. But on the other hand, if you risked only 2%, you would still have £13,903, which is only a 30% loss of your total account. Now, of course, that's the last thing I want, is for you to go out there and lose 19 trades in a row. But let's just say if you even lost 5 trades in a row, calculate the difference between 2% and 10%. So if you risked 2% and you lost 5 trades in a row, you would still have £18,447 to trade with. But what if you risked 10% and lost 5 trades? Look at the difference. You will only have £13,122. Now, that's even less than what you would have had after losing 19 trades in a row on only 2%. That's less than that. The point I'm trying to make is that you want to set up a strict risk management rule so that you can go through these drawdown periods. You want to still have capital to stay in the game. It's as simple as that. Can you imagine if you had lost 85% of your account? Now you would have had to make 566% in order to go back to break even. And trust me, you don't want to be in that position, because it is damn difficult. Even professional traders will give up. Okay, now I'm going to go through what do you have to do to get back to break even. I want you to take this concept. I'm going to show you a table on your right. I want you to view that table. Take a second and view that table for me. Now, this table will illustrate what percentage you would have to make to break even, to go back to break even, if you were to lose a certain percentage of your account balance. Now you can see that the more you lose, the harder it is to make it back to your original account size. Now, say you've lost 70%. In order for you to go back to break even, you need to be a 233% trader. Now that is damn difficult. Now this is all the more reason that you should do everything you can to protect your account. By now, I hope I've got it drilled into your head that you should only risk a small percentage of your account per trade so that you can survive that losing streak. And also avoid large drawdowns in your account. Okay, don't be a gambler, be that casino. Look at 80%. You need to be a 400% trader. Now go to a professional trader and ask him how difficult it is to become a 400% trader. Okay guys, I'm gonna be talking to you about risk to reward. Okay, reward to risk ratio and the importance of reward to risk ratio next. Let's move on to that. Okay guys, last but not least, we're on to reward to risk ratio. I apologize for the long video, but we're nearly coming to an end. Now, before you go, I need you to understand the importance of reward to risk ratio. And it's pretty simple. To increase your chance of profitability, you want to trade when you have the potential to make 2 times more than what you are risking. Okay? Don't go out there and risk, say for example, £100 to make £50 or £100 to make £20. That's just absurd. You are going to go broke. Before you know it, you're out of the game, you've got no capital in your trading account, and you're scratching your head what went wrong. I've created a table for you on the right. Please take the time to look at this. Okay, now I've gone on a 3-to-1 reward to risk ratio. This is only an example. Say you've got a reward to risk ratio of 3-to-1, okay, and you're a 50% trader, which means you win 50% of the time. You've got the 10 trades. Okay, I'm not going to sit there and do you a whole chart of entire years of this. Let's just say the first 10 trades, you've had 5 losses. Okay, you're risking £1,000 per trade. You took the first trade, you had a loss of £1,000. The second trade, you won £3,000. The third, you lost again. The fourth, you won. Literally, you lost 5 trades, you won 5 trades. At the end, your total loss was £5,000 and you won £15,000. Can you see how important reward to risk ratio is? Even if you're a 50% trader, you will still be profitable with a good risk management plan in place. Let me tell you one thing, even if you're a 40% trader and you've got an excellent risk management plan in place, a good reward to risk ratio, you will still be profitable. Now don't get me wrong, don't go out there, because large reward to risk ratios have their downfall. Okay, don't go setting absurd reward to risk ratio like 5-to-1. Don't expect to risk 100 to make 500, because most likely it's going to go down and hit your stop loss. Now personally, I'm going to give you what I do. My minimum is a 1-to-1. So if I'm risking 1,000, minimum I want to make is 1,000. I don't risk more than 2% of my account balance per trade. I have 2 positions per trade, which equals to 1% each. So in total, I am risking 2%. Now what I do is I have 2 targets in place. Once the first target is hit, I will move stops to break even. I'm managing risk. Now I've got a risk-free trade. Now one of 2 things can happen. Price can go back and hit my stop loss. I've not lost anything. I've already made money on this trade. Or it can go and hit my second target, which is probably a 2 to 1 to start off with. And if you put both of these trades together, I've made a good amount of money. Now this is what I need you to really understand. Have everything in place. If you want to be successful in trading, forget about the strategy first, right? Concentrate on risk management. I know, right, looking for entries is exciting. Looking at charts is exciting, but trust me, it gets boring. Trading is boring. It means you're doing it correctly. If it's exciting, then you're not doing it correctly. Alright? Eventually you'll notice that you're becoming robotic or mundane. You're doing the same thing over and over again, just different pairs of currency pairs. Stay focused. Understand what I've just given you today. I hope you've taken notes. If not, go back, watch this video again, taking notes, because I guarantee you it will be helpful, especially if you're a new trader, and embrace risk management right at the top of importance, and learn that first before you jump into all the fun stuff. I'd like to take this opportunity to say thank you for taking the time to come and watch this video presentation. I hope you all took away some valuable information. If you did happen to like this video, please hit that like button. It will show me your support, and hit that subscribe button alongside with the bell notification too. That will enable you to know as soon as I've uploaded my next video. In the meantime, I hope you stay well, and I'll see you on my next video. Thank you.